So nice to be here today. It's an incredible time to be around the financial services industry these days, with incredible innovation happening at all levels of FinTech, with seeing financial services access becoming so much more available to underserved communities from the past, payments being distributed across the world in no time flat, buy now, pay later innovation happening at all different levels of the payment industry, including things like donating with buy now, pay later, or donate now, pay later. I was just attending a session at Money 2020 last week, and they were talking about that. Really an incredible time to be around. The problem, however, is that with this massive innovation in the industry, what we're also seeing is that there's a lot of risk management components that are not being addressed. And with every new innovation that we produce, we are actually adding more risk to the environment. And as every FinTech leader probably has experienced already, that is becoming more and more of the massive load that is on their shoulders. When you ask FinTech leaders, what keeps you up at night, it's managing risk, managing fraud, being able to make sure that we are compliant and meeting our regulatory obligations, and so on. The problem is that when companies are not compliant, what we're seeing is that the number 2 reason that VC-backed FinTechs are failing is because of non-compliance. Usually, early stage companies fail because of lack of capital or problems with regulatory, problems between the founders and things like that. But with FinTechs in particular, there is way more problems than just those kinds of normal issues. The regulatory landscape has shifted over the course of time with the innovation increasing. And what we're seeing is that fines alone are impacting the industry at a clip of 160% year over year in terms of the increase in fines. But what is also happening is that the industry at large is paying today $53 million annually. And I'm talking about the US FinTech industry alone, not even outside of the US. But fines are only the tip of the iceberg. Unfortunately, what we're seeing is that there's way more that goes into problems with risk and compliance than fines. When 5% of the workforce gets pulled into dealing with a data breach, for example, when 10% of the customers decide they don't want to work with that FinTech company anymore because they lost some trust and now companies losing revenue. When product managers and business leaders get pulled into meetings to figure out how are we going to fix the compliance problem or deal with the problems that we just encountered, and they stop working on advancing their products, those are the kinds of things that actually lead to this kind of failure. And what happens is that loss of productivity, loss of revenue, loss of trust, effectively, is what causes these companies to lose way more than just the fines. In fact, what we're seeing is that in one calculation, it's about 7.5 times what the fines are. In other cases, again, just at Money 2020, last week they were saying it's actually 10 times the fines that companies end up paying. So, how do we get over this? How do we fix this? And I can share with you that from my experience of over 20 years in the industry, between financial services, regulations, taking care of third-party risk, and a whole bunch of other things, what I found to be most effective are exercises that engage the entirety of a particular company. When we try to manage risk in a siloed way across where each department is trying to deal with risk on their own, things fall apart and it doesn't really work. As the old saying goes, a company is really as strong as its weakest link. And as a result, what we want to do is we want to be able to create a culture where the entire company can think about risk. And in fact, that's where the regulators are going to, where they are requiring a company at large and its leaders to be accountable for risk across all levels of their bodies. So how do we do this? The 7 ways we'll talk about, we'll start with where it starts, and it really starts at the top. The leader of any given organization is obviously accountable, but also is at the heart of making sure that their entire organization is risk aware and can think about risk from that standpoint. In 2020, Citibank Group had to pay a fine of $400 million. They were also required to stop making any acquisitions without the consent, unless they get the consent from the regulatory authorities. That's Federal Reserve as well as the OCC in the US. And that came at the heels of a $900 million problem that occurred when some of the employees of Citibank wired funds to lenders of Revlon, which they should not have wired. It happened incorrectly and by mistake. And of course, that also came at the heels of a number of long-standing AML-related problems that the bank had neglected to deal with. So you kind of think around Citibank. I mean, it's one of the largest organizations out there. How could this even happen? And it's almost impossible to conceive of Citibank not having proper risk management practices. The reality is that they did not have risk management practices. They actually did have them. But the company at the top level, they were not really as engaged as they should have been. The leaders of the organization were not promoting risk management as a practice that everybody did within the organization. They didn't have the level of engagement that they needed to have. And that is what caused the failures. And that is what ended up costing them as much as it did. The second one is having clear values across the entire organization. Another story that we're all familiar with is Wells Fargo, where the employees of the company, 5,300 of them, over the course of 5 years, ended up opening accounts for customers who did not ask for them, did not expect them, and those customers ended up having to pay both fines as well as overdraft fees on accounts they didn't even know they had. Why did that happen? It happened because company employees, somebody in the revenue generation arm of the company, actually decided that it was a great idea to put very high incentives and targets for salespeople to open accounts. So without really thinking about what is the risk of that activity, what is the risk of setting those incredibly aggressive targets, unrealistic really. Well, human behavior is what it is. People needed to meet their targets, otherwise they were going to get fired. So what did they do? They opened up accounts. And this went on for a whole 5 years. 5 years. And the company let it happen. When eventually the regulators caught on and customers started complaining, and the U.S. Consumer Financial Protection Bureau decided to act, they went to the leadership of the company as well as their chief risk officer and talked about, what happened. And they said, well, you know what? We actually didn't know about this. This just happened on its own. We were not aware. And of course, the regulators did not accept that as a response. That was not, it was not okay for leadership to say we didn't know, because not knowing in this case is actually considered negligence as opposed to an actual response to this. They ended up obviously fining the company. I think the amount was in the neighborhood of $185 million. And of course, the scandal and the ripple effect from all of this was way higher from a loss perspective for this company than anybody could have imagined. So the point here is that when a company has clear values, in this case, it actually cut both ways. Their values were clear. They cared more about revenue and profits versus the customer, in which case the problem happened. But if a company has clear values around what they put up as their as what they actually need to abide by, this would never have happened, because company executives and leaders within the revenue stream would not have put profits ahead of customers. And that is exactly what we want to make sure that it doesn't happen within our own organizations. The other element here is that risk management cannot be, expressed as an afterthought. Risk management needs to be embedded within a company's practices from day one, and from the moment somebody gets onboarded as an additional employee of the company, they need to be indoctrinated into the system and understand what the risks are. In 2007, the U.S. issued the Sarbanes-Oxley, which we all are familiar with in terms of the audit requirements for financial reporting. But also, a couple years after that, there was another ruling by the SEC, which is a disclosure rule around ensuring that every company has a requirement to actually disclose what is their risk management practices, what are their enterprise risk management platforms looking like. And the reality is that what that did is that forced companies to either become efficient and report on their efficiency, or remain inefficient, but they have to also report on their inefficiency. There's no third way about it. It's really only one of two options that any given company has. And what this also introduced is the fact that the size of the company didn't matter. It could be a large company, it could be a small company. As long as they are providing financial services, they are required to provide that reporting to the regulators. An example of when things fell apart from an innovation standpoint, and we were talking earlier about how FinTechs have innovated dramatically and continue to innovate. The reality is that with that innovation comes risk. And one example that I've noticed, and it's not in the FinTech industry, but it's very palpable, is I'm not sure if Chipotle actually exists in the UK, but it's a well-known fast food outlet in the US. And they innovated on the fast food industry by introducing fast food that is locally sourced, that is healthy, that is very different from sort of the burgers and chips that existed before that. What they failed to do, however, is that as they innovated, they did not go after their supply chains and ensured that their supply chains from those locally sourced areas are as good as they could be or they should be. And as a result, they ended up with this massive salmonella outbreak, and so many of their outlets to the extent that they lost, their share prices went down by 35%, and they lost more than 30% of their revenue over a course of a number of years. And they're still reeling, actually, to this day, trying to get over that one problem, which happened quite a few years ago. And that brings us to the next point, which is constant evolution. The industry moves really, really quickly. And what's happening is that with the movement of the industry, not only are we creating new risks, but also the regulators are getting a little more and more attuned to what we are doing. And they are creating new rules. So one of the things that risk management is not a one and done operation. It's essentially us trying to continually change and evolve as the changes are happening. One really important element in all of this is effective communication within our groups. Making sure that we are open as an organization and that we are able to allow others to come in and share their thoughts and ideas about what's happening in their specific areas. And again, this is to promote a risk-aware and effective culture within an organization. There is, for those of you who may be familiar with the movie Sound of Music, there's a scene from the movie that's always left a mark on me, and that's when the character Maria was speaking with the captain about his children, and she goes, Kurt, which is one of the children, Kurt, you know, he feels so bad about how you treat him, and he acts, you know, very aggressively because he's trying to hide his feelings. And the captain goes, well, how dare you talk to me about my son? And she goes, well, Brigitte could tell you about him if you let her. She notices everything. Same with our organizations. People on the ground floor notice everything. People on the ground floor are in it. They see the problems. They talk to their customers. They know where the issues are. They know where the risks are coming from. They can see the newer risks that are evolving and happening every day. And as a result, as an organization, if we allow these individuals to speak up without any fear of retribution, then we can continue to promote a risk-aware culture. Internalizing the value of risk within the organization. Every person needs to feel that they are accountable. They own the risk, and they understand the value and the risk of not managing the risk. There was a company called Wonga. Maybe some of you are familiar with it. They provided short-term loans for customers here in UK. And they operated in between 2006 and 2018. And over that period of time, they used AI and other technology to underwrite loans to customers. And they gave out loans to 330,000 customers that were not deserved. Those are customers that could not repay those loans. But the company was so gung-ho on making profits and getting those loans out that they really did not put a lot of mind to the risk that they were taking as part of that. Long story short, they ended up having to pay the regulators $2.6 million at one point in time before they had to shut down the organization in 2018. And in my mind, the reason this happened is because the organization as a whole did not internalize the risk, the importance of risk, and the value of mitigating risk, because at the end of the day, what could happen is we shut down. And last but not least is embracing technology. Obviously, we are in an era now, and we are so fortunate to be living in this time, where there is so much that can be done with technology. There's so much that technology can do for us that helps us elevate our thinking and practices to take it a whole notch higher, to actually problem solve the things that only humans can do. At Halo AI, we are focused on ensuring that we get as much data into a given activity as possible. And we help organizations manage their risk in a way that is promoting a very cohesive culture of risk, understanding risk at every level of the organization across every risk domain. And we utilize machine learning and AI to come up with scores and enable our customers to get ahead of their risk and compliance problems. Of course, we're not the only company that does that. There's a million other companies that do that, and I would encourage all of you to think about how can you bring in technologies into your organization that can support the activity of ensuring that risk is handled across the entirety of the organization and not just in a very siloed way, as unfortunately is the case in many organizations today. Just to recap, it all starts at the top. Leadership needs to be at the heart of everything that we do. We need to have clear values and a common cause that we want to all rally around. Making sure that risk is not an afterthought. It's something that has to be integrated within every person within the organization. It's constantly evolving. We're never done with ensuring that we have risks covered, because new risks are going to come up every day. New regulations and compliance requirements are going to come up every day as well. Effectively communicating amongst ourselves within the organization, in and out, understanding what's happening from the outside world as well, which can impact our ability to meet our risk and manage our compliance obligations. Internalizing the value of risk and embracing technology as part of our day-to-day operations. Thank you.
Nice, Dina. Thank you so much. I've got a couple of questions, if I may, and then we'll go to the room. One line in your presentation there absolutely leapt out at me, about the line about without retribution. That's all hardwired in the culture of an organisation, which is it's the silver bullet, isn't it? In any organisation, if you get the culture right, the rest will follow.
Absolutely.
How on earth can you get that culture where there isn't that feeling that people can't speak up? What advice would you give for anyone to develop that culture? Because if you can have that culture, that's half the battle, surely.
Yeah, totally. It's all about transparency. It's all about making sure that me as a leader, I'm okay and I give permission to the people that are subordinate to me and to those subordinate to them to actually be okay, in fact, encouraged to come up with their ideas and thoughts around how to make things better. That's on the one hand. On the other hand, making sure that people actually know that they own the risk. Like, there's a difference between, paying lip service to risk management versus to actually feeling that I own the risk. This is my problem. Risk is not somebody else's thing that the risk manager is going to take care of it. Somebody in back office is going to take care. I'm just here to generate revenue. It doesn't work that way, because as you've seen from the Wells Fargo example, people on the revenue side ended up impacting the entire company. So the point is that people need to make sure that their team as a whole, as a company, we are being super transparent about what issues we need to care about, what issues our subordinate need to care about, and making sure that nobody ever says something and actually gets hit by something negative around that.
Well, I guess that's got to start from the top, because I'm sure every single person here will have worked for a CEO or something at some point who has said, we listen to our staff, and then around the water cooler everyone is going, Yeah. No, you don't.
Right. Practice.
Is that the exact example? It's got to start from the top, something
Absolutely,
like that.
100%.
So how do you hardwire it then? How do you make it part of the DNA that everyone takes that responsibility?
Yeah. The way I think about it is, honestly, as a new employee gets onboarded, with every new employee that gets onboarded, they need to be made aware of the fact that this company as a whole is one that is that cares about managing risk, and that is not going to put something else above that. And to your earlier point, if you do it in practice, if you actually walk the talk as opposed to just pay lip service to it, that's how we get there. That's the only way we get there, because there's a lot of, this all comes back to having these aligned values, right? So the value at the top is, yes, of course we want to generate revenue. That's my top priority too. But at the same time, I'm not going to put that ahead of making sure that, things are carried forward in a risk managed way and risk mitigated way. Not unlike how you hire people and make sure there's no water on the floor, they're not going to trip and fall. It's the same concept.
And I'll have one more question, if I may, before we go to the room, and that's, again, picking out on something you said that was an expression I loved, never done, never been done. Do you ever have the situation where someone says to you, yep, we've got our risk management sorted? Does that set alarm bells ringing? Yes. Absolutely.
Absolutely, 100%. It is never, ever done. There will always be new risks that get introduced with every new product, with every new nuance, even feature on a product. And of course, with new regulations coming about, with something else that somebody else is doing. Like, you gotta keep your head in the space at all times to make sure that you're staying ahead of what's going around you.
Okay, we'll go to the room quickly. Any questions for Dina from the room, please? Luke is waiting at the back with his microphone. Or are we all good? I think we're all good today. I think we've covered everything off. Thank you so much for your time, and a warm round of applause for Dina. Thank you very much.
Thank you, everyone. Thank you.